bounces. We're going to start off looking at Fibo chart patterns for opening gap and pre-market trades. Here's an example, a 2-day chart, PMCS. One thing to learn, Fibonacci retracements, typically it means that stocks will trade to about a third or a half of their previous ranges, 38%, 50%, there's a number of different percentages. I typically will mentally divide the chart into 1/3, 1/2, and 2/3 breakpoints or ranges. So what that tells you, for example, PMCS, you can see here gapped all the way from 33, opened up at 37.5, sold off to about half of the range here. And if you look at the midpoint here, that's roughly half of the range of the open. And what that tells you is if you're in the stock, say you short the open gap at a 36.5 or 36.6, something like that, that tells you that you shouldn't expect for the stock to go all the way down here, that you should start trailing a closer and closer trailing cover stop as you approach roughly a third to a half of the range that the stock's established in its pre-market gap. So that's one thing to be careful with, just to be aware of on your opening gaps, whether it's to the upside or if you're buying a stock that had gapped down and is bouncing, you should expect to get only a third to a half of that trading range for these large multi-point moves. It'd be very rare for it to gap all the way up here and give you short all the way down to the previous close on a 3 or 4 point gap. Okay, let's take a look here at Qualcomm as another example. What you'd expect here is that the stock gapped to a new high, which is good, and made a cut pattern here. You might be able to get in here at the 66.5, out up right over the 67. This is that 3-line break that we had mentioned in the candlestick. If you're in on the 66.5 on that breakout, again, we'd be looking to get out towards the top of that third candle or out near 67. That's a 10-minute range. That's how I would be trading it to get maybe 5/8 of a point or so on the way up. You can see that it will retrace within a third to a half of the previous ranges. So it gets the buying all the way up here, it sells down and bounces to about midway of this range, and that's something to look for. Another example, RFMD, the stock gapped up and sold off, and for stocks that gap up not multiple points, but say just within a point or point and a half, you can use the previous day's high. If it closes like this, you can look for these things as support levels for the stock. So these are important to be aware. You see it bounced a couple of times off the support, which became resistance. It was resistance in the previous day, became support today. Looking from a Fibonacci standpoint, the stock will bounce to within maybe a third or a half of the previous range. You wouldn't expect it to sell down and get all the way to make a large 1-point cut pattern and breakout. Instead, it sold off, bounced to about midway, and then sold off some more, bounced to midway, sold off, got some buying to midway of the previous range. So for opening gaps, that's one thing to be aware of using a 2-day chart here. For the first 30 minutes of the trading day, let's take a look at a couple of patterns here. Using Adobe, we've got an example here where the stock sold off sharply, and you can see it bounced to where? About exactly half of this range. So this is, again, an important pattern to be aware of, that when stocks do bounce and they get a bounce over a previous high, that would be an entry here over 37.5, you'd only be able to expect maybe midway or 38 out of the trade, so these are, again, bounce trades where you're fading and going against the major trend, typically not as high potential because they'll usually only retrace to from a third to a half of the range that was established in the major trend. Okay, does that make sense? The stock here gapped up a bit on the open, sold off from 39 to 37 and bounced to exactly where? 38, which is the precise 50% level of the range. It's half the range here. So that's a good point to make, and you should be aware of that pattern. Here's another example, IDTI, stock sold off. This is a 2-day chart, sold off and bounced. You can look at the 2-day patterns too. I do that frequently. Most of my trade decisions are made on a 2-day pattern that I'll then zoom into the half day to look at the micro trade, to time the exact entries and exits. So for example, stock bounced off what would be half of the 2-day range. If you look at that entire range you're always looking for these patterns because they're where your probability zones are. So roughly half of this is where the stock chopped and consolidated around. So if you had shorted a cup, you'd be looking to get out around half. You wouldn't expect this thing to tank all the way to the previous day's support. You'd take your initial profits on any triggering of a stop loss that would, or a trailing stop that would take the stock back to the midpoint. Okay, let's take a look at our post 10 a.m. trades. I'm going to look at IDPH as the first example. You can see a bounce here right after about 10 o'clock. See, the point on these is you want to be able to identify where the stock's going to be trading and where the bounce is going to occur using Fibonacci retracements. And here you can see with IDPH, it traded the range that would be, this is what I call a reverse Fibonacci, is that the micro range here, the range that it establishes bisects or makes 50% in the previous day's range. So this entire range is twice. So for example, the stock closed off here, gapped up here, it started to selling down. You wouldn't expect it to sell an equivalent amount of the entire previous day's range, but only an equivalent amount of the opening gap. And in this case, it sold off from 53 to 51.5. The further range was another 1.5 points. Okay, this is a Fibonacci in reverse, or halfway of the trading range, sold off down to the 50. So that's something to be aware of too. These Fibonacci patterns, or the 50% ranges, can work in reverse too. And this is a relatively wide range open because it exceeded and went below the previous day's low here. Okay, and let's take a look here at Cisco as another example. You can see often that when a stock, on a day where the NASDAQ either gaps up and sells off or just opens flat and sells down, you frequently get 1030 bounces. And you can see here the stock, Cisco, bounced off its support near 20 and went up to 20.2. This is around the one third of this range, close to a half of the range. And again, a good reason why bounce trades aren't quite as good as trading with the major trend, because your trade potential is limited to about a third to a half of the range that's been carved out. So here's an example of a 1030 bounce. The stock sold off in a technical downtrend. You can see the lower lows, lower highs, broke the trend here and established into a small uptrend around 1030, but not really too much in terms of trading potential. So that's another thing to be aware of, 1030 rule, and that our bounces will typically only go a third to a half of the range. And let's take a look now at our chart patterns for buying gaps up, or buying the gaps down, shorting the gaps up. Let's use NVIDIA as a quick example. You can see the stock gapped up to a 2-day high, which is great, but it was making a cut pattern on the open, which would yield a short, say, at the 86.5. Right? You can see here this is a double bottom, and if you could get an uptick to short into, this would be the short on weakness. It would go down here. I'd be covering around 10 o'clock. So best that I would get in my trading style, say I short the 86.5, I'd be out here around 85.6 or so for about a 7/8 or so win. I wouldn't have held the stock all the way till 10.20 because I've been in short at, say, 9.50 or so I'd be covering here around 10 in case it was getting buyers again. So I'd be trailing a close stop and probably be out here around 85.6, 85.5. So that's a open pattern, and from a Fibonacci standpoint, you can see the stock again. If we look at the range where the stock was trading in the previous day, you can see that that's about half, or Fibonacci retracement, of the anticipated or total range that was carved out in the first half of the session. So these things are useful to know, is that you can typically expect a 50% on either side of a previous consolidation area like this one, or a key support or resistance level. And a final example, SEBL, SEBL. Again, this is a pretty choppy chart. 2-day, you can see it sold off to the previous day's close and bounced to around the mid-range. So again, these things are patterns to be aware of in terms of the 50% ranges. The best example, again, on these 2 days is PMC Sierra. You can see it sold the gap up, and typically you do look for fades for stocks that gap over 2 or 3 points on the open. They typically won't continue, but again, you want to make sure you get a cup confirmation, and you'd expect or anticipate that it wouldn't sell all the way down to the close, but rather at about half of the range here. So that's a quick start on Fibonacci retracement bounce chart patterns. And again, these two, like candlesticks, are more for advanced traders because you're looking at anticipating exit targets based on the stock retracing a third to a half of a large range that's carved out in the first part of the trading session.